All right, equity futures dropping right now on this Friday morning after PCE comes in hot. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Danny Berger. Matt Miller and Shonali Bastick are off. Open interest starts right now.
Coming up, Coreweave's IPO on deck. The heavily downsized offering debuts on Wall Street today. We'll follow all the moves. Meanwhile, consumers are overstretched, and that's not a good look for Lululemon. We'll have the latest on the company's disappointing forecast. And more cracks in the consumer. A key inflation gauge picks up as spending barely rises. All of that and more coming up. But let's take a closer look at Lululemon right now. It's one of the biggest movers in the pre-market to the downside. The athletic wear brand warning about consumer spending in the U.S., and you can see that warning coming through in shares right now, Danny, currently off about 11%.
Yeah, one of the latest consumer companies really to do this. Katie, tariffs and autos still in focus today. Tesla, though, trading to the upside in the pre-market. It's outperforming the others and outperforming the Mag 7, I should say. So perhaps we are in a situation where Tesla is less exposed with more factories in the U.S. That compares to a GM, to a Stellantis, Katie. Those have been crushed over the past day.
Yeah, we'll keep a close eye on those auto stocks for Matt Miller in absentia. But let's get back to one of the big stories of the day, and that is Coreweave. Begins trading on the NASDAQ today after significantly reducing the size of its IPO. Let's bring in Bloomberg's Bailey Lipschultz for more. So, Bailey, once upon a time, Coreweave was looking to raise $4 billion in this IPO. That would have given it a valuation of about $35 billion. Those ambitions have been dashed just a little bit.
Just a bit outside, Katie. They even launched a week ago. Not much has fundamentally changed, if anything at all, targeting up to $2.7 billion. They ultimately printed last night at $1.5 billion, with NVIDIA shoring up the book, taking about 17% of that IPO. So right now, looking at that on a fully diluted basis, about $23 billion, which is in line with their last private round. Investors had been pushing back on the last week.
Why? Why have they been pushing back, Bailey?
Debt load. A small moat. We saw some results from an RBC anonymous buy-side survey that really called out concerns around its need to spend. It's going to have to sell either equity or debt to continue to fund these ambitions. There are also overlying questions of concentration around customers. More than 3/4 of it is driven by Microsoft and NVIDIA. We've seen the headlines from Cowen saying that Microsoft is pulling back that spending. That caused some jitters. And really just the overall kind of math that they use with depreciating some of these chips. If NVIDIA is coming out with a new chip every other year, what does that mean for a company that essentially buys GPUs and just rents them out?
Yeah, it really feels like there's two issues here that could be spooking investors right now. You have just the overall market environment, all the volatility that we're seeing around tariffs. But then, as you mentioned, I mean, it's just fundamentals concerns that there's maybe a bubble of sorts forming in AI infrastructure, which, of course, is Coreweave's bread and butter.
Yeah, it's poorly timed for Joe Tsai to come out and say exactly that, that this is a time where you should be concerned.
He's shorting it.
Your words, not mine. But it is an interesting time. Again, people are pointing to April 2nd, that Liberation Day, as Donald Trump puts it. What does that mean for risk appetite? And more importantly, what does that mean for investors who don't want to go out on the risk spectrum with a new company with these kind of underlying concerns about the business model, again, in a market that seemingly is pulling back from AI investment?
Yeah. Probably some people unhappy with Joe Tsai, maybe getting some phone calls, maybe even more phone calls now, Katie, because of you.
That was a joke. Let me just put that out, full disclosure.
Good clarification, Bailey. Thank you so much for joining us. That is Bloomberg's Bailey Lipschultz. Now, elsewhere in tech, the EU is considering hitting back at big U.S. tech companies in retaliation for 25% on the auto industry. That, according to the FT. Joining us for more in Washington is Bloomberg's Michael Shepard. Shep, just how much are they really hitting back? Or is there a sense that these fines aren't going to be as punitive in order to avoid the ire of Trump?
Well, it's a good question. The companies certainly have been pushing for perhaps more lenient treatment from the bloc since even before Trump took office. They have been pressing Brussels to maybe take it a little bit easier in enforcement of the Digital Markets Act and also in the application of the Digital Services Act there, both of which have imposed some costs on the companies in terms of taxes on the services that they provide and also regulations that increase their costs for doing business in the region. And of course, these are two sticking points that the Trump administration has brought up. Perhaps most visibly, we heard that from Vice President J.D. Vance during his visit to Europe last month. He took part in an AI summit where he raised this issue, and also at the Munich Security Conference, where he really hectored officials over regulation and over this posture that he viewed as very heavy-handed in their view. And this is part of the trade conversation that the U.S. is having here when it comes to Europe and tech.
Yeah, absolutely. Just one of these negotiating chips on the table right now. But let's zoom out a little bit and talk about the stakes for the industry. Shep, give us some context here.
Well, the context is that a number of these companies do quite a bit of business in the EU, in the European region. If you look at Apple, it's about $100 billion of business last year, roughly the same for Alphabet. So the stakes are not small. And there are other companies, too. When you think of Meta, they don't have nearly the same footprint as they do perhaps in the U.S. or maybe in Brazil. But the EU is nonetheless a significant market. And we've even heard from Mark Zuckerberg complaints about how the Digital Markets Act and some of its enforcement and content moderation requirements have really been a drag on the company. And those are things that he has pushed back against here in the U.S. Now, flipping it back to tariffs, what the EU is considering in terms of reprisal, not just over autos, but whatever we might see on April 2nd, they are looking at going beyond just tariffs as a countermeasure. They may go after intellectual property of big tech companies. This would be under the anti-coercion instrument that was established during Trump's first term by the EU during Trump's first term as a way of countering the first trade war. And another way they could get back at them, of course, is via Elon Musk, perhaps banning his company Starlink from gaining government contracts in the region. And that would be over his role in the Trump administration these days.
Yeah, that would certainly send a message. Great reporting, as always. That is Bloomberg's Mike Shepard joining us from D.C. Let's keep this conversation going now, because it's a rough ending to what's been a challenging week for the tech sector. As we were talking about, Alibaba's Joe Tsai warning about a potential bubble in AI infrastructure on Tuesday. Now, that was followed by a Cowen report saying that Microsoft is canceling new data center projects due to oversupply. Bloomberg's Caroline Hyde joins us now with a closer look at how it's impacted big tech this week. So, Caroline, what's the damage?
Well, a continued pressure on some of the key AI players, a continued concern over Coreweave in particular, and what that signals about NVIDIA, about Microsoft, about Amazon. But I think what's interesting is we've got a tale of two cities here. Yes, you are worried about data center compute, whether we got an overcapacity, whether Microsoft was withdrawing from its overall leases, and that's something that you were signaling that TD Cowen's been writing about time and time again, and Joe Tsai's warning. But on the flip side, you've got Sam Altman going on to X saying our GPUs are melting at the moment because everyone is in such a frenzy to generate a fun image of themselves that they can't cope with it.
Though, wouldn't he?
Well, I mean, he's not in the game of giving compute. He's in the game of giving you absolute demand and ability to use generative AI. What's interesting with Coreweave is, yes, we've had worries about them being too exposed to Microsoft, but they recently inked a massive deal with OpenAI. And so I think here is the test case. Are we using generative AI in our enterprise world, in our personal world, enough to vindicate the $80 billion being used by Microsoft to spend on it, the capex being promised by Amazon, and the overall, even China? I mean, Joe Tsai can say that there's some sort of bubble going on, but you've seen more than $50 billion being allocated to GPU rollout, to capital expenditure on compute by Alibaba itself. I mean, everyone wants in. The issue is we need to start seeing the use cases, and we're finally getting them.
Yeah, and I'm looking forward. Katie and I are going to be speaking with EQT's head of U.S. infrastructure, who also just raised a big fund in part to do what you're talking about. So this slowdown necessarily hasn't happened, but how much of this also, the tech damage we've seen, is just also about China catching up? It feels like over the past 5 days, we've had story after story of new AI model and some advancement that's been happening in China.
You're so right. And I feel as though it's suddenly the solar moment, the EV moment for generative AI. China's coming out and saying, we can do what you do, but more efficiently, more cheaply. And boy, are we going to start making all those generative AI bots and chatbots even more accessible. Most people I speak to will say that is nothing but good for the the overall ecosystem. The fact that you and I can start to have personal assistants at a cheaper price point is going to mean explosive growth for generative AI and mean that we use inference yet further. And that's, of course, what Jensen Huang's been trying to convince us of. But I do think that there is this moment of reckoning that China is able to compete in a phenomenal way versus the United States. We've meanwhile got the pressure coming on big tech because we're worried about tariffs. We're worried about AI diffusion model. We've got a great guest coming on, Robert Oxman, a little bit later to discuss, really, is that going to be imposed into the United States? Are we going to have a limitation on selling into our allies as well? There is so much reason to take risk off the table at the moment rather than pile in.
Absolutely, and you're seeing that in the markets right now. Caroline Hyde, great context as always. And speaking of tariffs, we do want to bring you some breaking news, and that is that the EU plans concessions for Trump after reciprocal tariffs hit. To bring you a little bit more detail there, specifically, EU officials were told that new auto and reciprocal tariffs will be launched next week, and discussions began on what a potential deal to reduce them would look like. And as such, the EU is working on a, quote, term sheet for a potential agreement which would set out areas for negotiations on punitive trade measures. This coming from our Bloomberg News team. Danny, you see the reaction in markets right now. S&P 500 futures not moving too much on this news, but you take a look at the currency market, specifically in the Euro-USD pair, and you do see the pair climbing higher right now.
I think there is maybe a hesitancy, at least in equity markets, and what we're seeing on this idea of if they come up with a term sheet, if they actually do things to placate the Trump administration, will it work? Donald Trump himself has said that these are permanent tariffs. They aren't really we've had this question of what are tariffs for? Are they a negotiating tactic? Is it to get deals done? Trump has been speaking in a way that suggests it is to fix a wrong, to fix a trade balance. So will this really go far enough when he is saying there will be no exemptions, or at least few exemptions?
Yeah, and it's interesting to see investors try to parse that. I mean, I was in Las Vegas at the start of this week. I was speaking to DoubleLine's Jeff Sherman, who was saying you have to take Trump literally, not just seriously, literally. But you take a look at the market reaction to tariffs, it still feels a little bit muted. You do get these moves in the currency market, for example, where more of the direct impacts would flow through. But it does feel like there's still this sort of skepticism as to whether these are permanent.
Well, part of the problem is that companies themselves, when they're giving updates for their earnings, they're not including tariffs in their outlook. Sure, you get the one-off comment from Lululemon saying that we'll have slightly worse margins because of tariffs. But S&P did this really interesting study where they looked at the calls so far from companies, and people aren't talking about tariffs, so it is maybe not priced in yet.
Yeah, absolutely. We'll have to continue to watch this story. But just to bring you the headline again, the EU is identifying concessions to make to the Trump administration to secure a partial remover of U.S. tariffs that have already started hitting EU exports. We'll continue to watch that and the market reaction. But coming up, as we mentioned, things not so calm at Lululemon. Shares plunging right now after the CEO issues a warning about a consumer slowdown. Details next. This is Open Interest.
Now to high interest, let's get you a look at what is making headlines around the world. Eli Lilly's Alzheimer's disease drug failed to get the backing of European regulators who said its benefits don't outweigh the risk of potential fatal bleeding in the brain. The committee noted 3 deaths of people treated with the medicine. Eli Lilly now has another 15 days to ask for review. Those shares down about 0.5%. And PCE, the Fed's preferred inflation metric, it's rising at a stubborn pace in February. The data suggests that weakening household demand and a more guarded consumer. Now, speaking of a guarded consumer, Lululemon getting crushed in the pre-market, down more than 11.5%. It was a disappointing outlook, but perhaps more notable than that, the company saying that shoppers are pulling back because of geopolitical uncertainties and rising inflation, Katie.
Well, to that point, Danny, Lululemon is joining a growing list of retailers really sounding that alarm. Target, Best Buy, Nike, all voicing similar concerns this month. The latest warning from Lululemon CEO Calvin McDonald saying, quote, we're operating within a dynamic macro environment that's really contributed to a cautious consumer. We've seen a material impact to traffic across the industry. Let's unpack all of that now with Andrea Felstedt of Bloomberg Opinion. Andrea, so you take a look at Lululemon's plan. They want to expand into categories like golf, tennis, more deeply into running. Is that going to actually boost demand, or do we just have to get through this period?
Well, it should do. I mean, they have looked through the noise, and they have taken some really, welcome steps. Really, that last year they said they didn't have enough colour in stores. Well, they've brought sort of lots more colour into stores. There's been concerns that tight-fitting leggings are out of fashion, where everyone's going for a wider leg pants. They're introducing wider leg pants. They're doing all the right things. The trouble is, they're saying this has come up against a much more cautious consumer.
Andrea, thank you so much. Andrea Felstead of Bloomberg Opinion. Those shares down about 10.8% in the pre-market. Let's get back now to a Bloomberg scoop. The EU identifying concessions that it's willing to make to Donald Trump's administration to secure the partial removal of U.S. tariffs that have already started to hit the bloc's exports and are set to increase after April 2nd. Let's go straight to the White House, where Bloomberg's Tyler Kendall is standing by. Tyler, what did we learn that the EU's plans are?
Yeah, hey, Danny. Well, importantly, we are also learning that this came after the EU trade chief was here in Washington earlier this week, and sources familiar telling Bloomberg News that the officials left that meeting with the understanding that the U.S. didn't really want to negotiate ahead of April 2nd, and that helped to put together this so-called term sheet. It does include lowering duties, mutual investments, and easing some regulations. We know, of course, that the EU has already floated, for example, that it would lower its trade barriers when it comes to industrial goods, as well as boost some imports of U.S. LNG. That had already been on the table. But we have to keep in mind that these reciprocal tariff plans on April 2nd also include those non-tariff barriers. Think of the VAT and also DST, digital services taxes, and that those had been really a big part of the discussion here in Washington this week. Unclear how far they will go on that. I was here at the White House earlier when Kevin Hassett briefed reporters and said when he was asked if the U.S. is really asking the EU to dismantle some of its key tax priorities, he said the U.S. would be realistic in that regard. The other factor of this, of course, are those sector-specific tariffs that we are expecting later down the road and how the EU could be positioning ahead of that. Of course, the auto tariffs this week, but other key industries to the European Union, such as pharmaceuticals, are also expected soon.
All right, Tyler, appreciate you keeping on top of this story for us. That is Tyler Kendall joining us from outside the White House on that Bloomberg News scoop that the European Commission is planning a term sheet of concessions to bring to the Trump administration in these tariff talks. That headline breaking just a few minutes ago. Let's take a look at how it's rippling through the markets. You actually have the S&P 500 paring losses a little bit ahead of the opening bell. We had been down about 0.4% earlier after we got hotter than expected PCE rather, but you can see coming back a little bit. The NASDAQ 100 still down on the session. The Russell 2000 fighting to go green. We'll see if the small caps get there. Now, with less than 12 minutes until the opening bell, we're joined by Lisa Shallett. Coming up next, that is Morgan Stanley's Wealth Management Chief Investment Officer. Don't go anywhere. This is Bloomberg.
I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
The pullback in growth is quite substantial. They're trying to level the playing field to some extent. And ultimately, the goal is to improve the competitiveness of the U.S. economy and U.S. Corporate sector.
What is the probability that beyond next week, beyond April the 2nd, we're putting completely to rest the tariff issue? We're no longer talking about tariffs at all. I think, that probability is probably very, very low. I have very, very low confidence myself in calling what the actual measures are going to be.
HSBC and Barclays earlier this week, both of whom are getting more bearish on U.S. equities due to looming tariffs and weakening data. Joining Katie and me now, I'm pleased to say, is Lisa Shallett, Morgan Stanley Wealth Management Chief Investment Officer. Lisa, so great to see you. Look, the bears are starting to emerge. And the companies are starting to get more dour. Lululemon today, we've already seen the likes of Best Buy, Delta, Nike, Walmart warn on consumers, and PCE showed a slight less spending by consumers than we expected. Can we call a bottom in this market yet, or are things just starting to deteriorate?
Well, look, I think we need to have some context here. We've had an uncertainty shock. We've seen that manifest itself in consumer confidence getting hit pretty hard. And I think that most folks who are just, being completely data driven are taking down GDP estimates and are taking down some of their estimates of consumption. Now, that having been said, we're moving from an economy that's probably growing GDP at about 2.5% to one that's growing at about 1.5%. That's not a recession, and it's really important to remember that. So our view is, yes, do we have to recalibrate? Do some expectations need to be reset? We came into the year with, very rich markets and very high expectations. Do we need to recalibrate? Yes. Some of that has been done with some of the market damage in this 10% correction.
Well, the flip side to some of these growth concerns are fears about inflation. We got PCE this morning coming in higher than expected when it comes to the core reading, both on the annualized and the monthly basis. I mean, how do you position around that when you consider also the fact that, a lot of these tariffs haven't even kicked in yet?
Yeah, so our solution to this potentially, quote unquote, stagflationary environment, one where growth is slowing and inflation is quite sticky, is to be extraordinarily selective, to look for growth at a reasonable price, look for those companies who are navigating and can navigate around some of the headlines. Who are the more branded oriented manufacturers who are out of the line of fire of tariffs, and look for opportunities there. It's one of the reasons why, if you're a passive investor, we've been recommending an equal weighted S&P 500 index. If you can, put your money with an active manager, that's our preference. Pick some solid, good quality cash flow oriented companies who are positioned to navigate despite these tariff headlines.
All right, Lisa, we're just getting started. We're going to take a quick break and come back for the market open. That is Lisa Shallot of Morgan Stanley Wealth Management. A quick check on futures. You can see we're looking to start Friday on a down note. A lot of cross currents in this market. We'll bring you all the action at the opening bell next. This is Open Interest. All right, we are moments away from the start of trading on this Friday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You can see we're down pretty enough in the pre-market to make you worried about the weekly gain on the S&P 500. We're up just about 0.4% for the week, and we'll have to see what happens once the day really gets going. But if that gain holds, it would be the second consecutive weekly gain on the S&P 500. It's been a very trying time, so we'll just have to see. But in any case, you can see that the bell's ringing both at the New York Stock Exchange and the NASDAQ. You have Coreweave ringing the bell right now, debuting today on the NASDAQ. This was an IPO, a company that was looking to raise $4 billion. That's since been downsized to about $1.5 billion. We'll continue to watch when trading begins, but let's get to some of the biggest movers at the opening bell, and we start with Lululemon plunging after a disappointing outlook was delivered for the year. Also, the company voicing concerns about consumer spending in the U.S. You add it all together, you can see shares currently off by about 12.6%, really deepening those losses that we saw in the pre-market days.
Because everyone's buying Vuori, right?
Exactly.
That's
At
what's
least
behind it.
my mom is, yes.
And she is the most important gauge for consumers, I think, Katie. I'm looking to Tesla barely holding on to gains. It was up remarkably more in the pre-market, up some 1%. Now we're just up about 1/3% in some change. Investors are having a really difficult time pricing in what tariffs and what auto tariffs will mean, especially now. We have this news that the EU, a Bloomberg scoop, the EU looking for concessions to give Donald Trump to try to lessen some of the tariffs. So does Tesla remain a winner, or do we see maybe some of the U.S. auto manufacturers try to come back with that latest news, Katie?
Yeah, and speaking of tariffs, of course, we have Apollo's Torsten Slok writing this morning that tariffs have at least two negative short-term effects. In his latest newsletter, he wrote that elevated uncertainty has a negative impact on household and corporate spending decisions, and also that tariffs have a negative impact on corporate earnings as companies experience higher production costs. Still with us is Lisa Shallot of Morgan Stanley Wealth Management. And Lisa, I want to talk about that second point there, that the negative impact that tariffs have on corporate earnings is what is really going to hurt in these markets. From where you sit, how do you even start to model out the impact here on earnings estimates with all the back and forth that we're seeing on trade policy?
Well, I think doing the modeling is going to be incredibly tough from a bottoms-up perspective and the individual company and sector analysts. For us, it's a little easier. We're strategists, we're macro top-down folks. And I think, what we're seeing is that our best guess is that, if you just start with that GDP downgrade from what most folks had thought, might be a 2.2% real GDP this year, to something a lot closer to 1.7, 1.8, that 40, 50 basis point difference, how does that flow through to corporate profits? And our best guess is that we end up taking the $270, $271 per share number down to about 262. And so, with that, you can recalibrate your price earnings ratio and you say, look, this market is still selling at about 21.5, 22 times that new revised number. It's not super cheap at that macro index level. And so, our recommendations have been, since we probably are still going to have a soft landing, we're still going to avoid recession, now's the time to be a stock picker and to look for growth at a reasonable price. And we're finding some of that in areas like financials, like some domestic industrials, like some of the energy linked and energy infrastructure spaces, like software in technology, parts of the healthcare sector are places where earnings should prove to be resilient even with all this chatter about tariffs.
Lisa, I really don't envy your position. Yes, there are opportunities, but it feels like every single day you have a new input and thing to calculate with tariffs. One of the most recent one was a story from the Wall Street Journal that President Trump asked the auto manufacturers, or really implored them not to raise prices or else there would be retaliation. Steve Englander of SocGen basically said that Trump is being interventionist despite hopes of him going along a deregulationary type of agenda. And that means American exceptionalism is going to start to wane too. Lisa, would you go that far? Does this type of intervention hurt American business and U.S. exceptionalism?
Yes, I think we have been in that camp that says, as much as we may be on a path to rebalance the U.S. economy as part of, the current administration's agenda, we need to appreciate what contributed to U.S. financial markets exceptionalism over the last 10 or 15 years. And a lot of it, had to do with corporate profit margins being able to expand. And so to the extent that, you're going to impose tariffs and then you're going to say to companies, don't pass these pricing pressures on to customers, it means you're asking corporate America to suck it up in terms of margins. Well, one of the things that had the world coming to invest in America was our economic growth, number one, and number two, those corporate profit margins, which are the envy of the world.
Yeah, that's certainly a tough ask to make of corporate CEOs. Fantastic reporting in the Wall Street Journal about what those conversations with the auto industry sounded like. But before the break, Lisa, you were talking about how to invest amid all of these cross currents. You mentioned focusing on domestic names, domestic brands, and I actually wanted to talk a little bit about small caps. You mentioned that that would lead many to the equal weighted index, but I've also heard that as a bull case for small caps in particular. But you're taking a look at that chart right now. You can see that the Russell 2000 has pretty solidly underperformed broader indexes such as the S&P 500 year to date. When might we finally see a sustainable bid materialize?
Well, here we may have a bit of a controversial view, and we have not been prepared to encourage our clients to chase small caps. Our view is that the small cap public stock universe has profoundly changed over the last decade as a result of the extraordinary growth of private equity. And we believe that the index is experiencing what we call adverse selection, where the best companies that once were in the small cap universe are today within financial sponsor portfolios, and that the public index, its qualities, right, its level of profitability is structurally different than it's been historically. In fact, even today, where the US economy is chugging along at about 2% GDP growth, roughly 45 to 50% of the small cap public universe is unprofitable. These companies are very dependent on low interest rates and access to low interest rates. As we know, interest rates are sticky because inflation's been sticky. And so small cap companies have quite a lot of headwinds when it comes to access to capital, in addition to their lack of scale and their lack of profitability. So
Lisa,
we're not chasing those small caps.
It's a fascinating point, one that I've heard a little bit before, that basically, to your point, that you have all these small companies happy to stay private. They can get the funding there. They don't need to go public. And I've heard that used as a case for that's why you should go to active management, specifically in small caps. But is it fair to say that maybe you're saying that the juice isn't worth the squeeze there?
We are saying the juice is not worth the squeeze. I will take that quote from you. Our preference is, for those investors who want a little bit more octane, a little bit more high beta, which traditionally small caps have given you. We think you're going to find it perhaps in the private markets.
Lisa, so wonderful to have you on and get your thoughts. Lisa Shallett of Morgan Stanley Wealth Management. Coming up on the show, Oracle shares down on the Pentagon's plans to cut costs. We'll have the details for you next on Open Interest.
All right, welcome back to Open Interest. Let's get a check on stocks right now. The S&P 500 down by just about 0.3%. It gets a little bit worse if you go out to big tech, and the small caps also feeling the hurt right now. We are on track for a weekly gain, which would be the second weekly gain for the S&P 500, but all told, we're headed for the worst quarterly performance since 2023. So keep an eye on these indexes. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Barclays upgrading Ferrari to overweight, seeing an attractive buying opportunity following recent declines. We've gotten a lot of noise around tariffs, but shares up about 2.5% right now. But moving on, Lululemon getting a downgrade from Raymond James to market perform. The analysts moving to the sidelines due to mounting uncertainty surrounding Trump's tariffs. And finally, we have Jefferies upgrading Applied Materials to a buy, expecting shares to benefit from the company's shrinking exposure to China, Danny.
Katie, another stock on the move this morning. Oracle shares down less than 1%, but still decisively lower. The U.S. Department of Defense said that it will terminate a plan to use Oracle software to manage its civilian workforce. Joining us for more is Bloomberg tech reporter Brody Ford. Brody, what's going on here? Because it was our understanding that the chairman of Oracle, Larry Ellison, was close with the Trump administration. Why the backup?
The fear for software companies right now is that Doge is going to cut their big federal contracts. A lot of these incumbent software players, Microsoft, Oracle, Salesforce, they make billions selling to the government. And as you said, Oracle has this kind of unique position where Larry Ellison has a kind of famous relationship with Trump. A lot of folks maybe assumed they would be insulated from this action. From where I said, this is the first major contract we've seen with Oracle's name on it being cut as part of the whole greater Doge operation. And so, yeah, it shows that kind of no matter who you are, if you're selling to the government, there's a good chance that your contract's going to get a little mixed up here.
Yeah, I'm sure there's plenty of nervous C-suites right now, but give us some details here when it comes to this specific program. Of course, this isn't a cost-cutting push. How much money could this potentially save? What kind of numbers are we talking about, Brody?
So this is one of these classic federal tech contracts that gets announced years ago, and they give a number that seems reasonable. They said it would be $75 million to get it done in a year or two. It is 6 years later, and it's not operational. I mean, I've spoke to sources who worked on this contract, and they said, yeah, no, I mean, something was for sure going wrong here. The thing that's tough is that a lot of this money's already spent, right? I mean, the government doesn't get their however many million back when they cancel this. It's the opportunity cost of, is it cheaper to build something different going forward versus, trying to make the same system work? I am not certain that whichever vendor they go with next is going to be able to get something working, because the issue with federal government tech a lot of times is that a lot of the back end infrastructure is super old. You're trying to get data about 900,000 people across the country. These are tough projects that are subject to some pretty incredible overrun.
Brody, even so, if we can just zoom out, because government spend on technology has given us a lot of innovation throughout decades, from the internet to GPS to semiconductors. If we are entering a time where that spend is being pulled back, is there a consequence for advancement and innovation in tech, even if you have the private sector and its ability to continue to spend?
Yeah, I think that seems like a fair read on the situation. I mean, we have to remember that, yeah, like you said, a lot of these projects are already private sector. I mean, this is already the government saying, man, we probably can't build this in-house. Why don't we just get Oracle and Leidos to do it? And so the fact that they're cutting the private sector contracts, I'm not totally sure what replaces it. Probably they just find a different vendor who says they'll be able to do it even cheaper. I mean, who suffers? Does it mean that, it's tougher to onboard civilians to the DoD and they end up getting worse workers as results? That could certainly happen. I mean, yeah, I think it definitely holds the risk of making, federal agencies run even more slowly, at least in the, interim.
All right, Brody, great reporting. Appreciate your time on this Friday. That is Bloomberg tech reporter Brody Ford. Of course, all of this coming as part of the push of Elon Musk's Doge to really cut spending at the government level. And actually, there was an interview that he did with Fox News yesterday saying that the new target, the more near-term target, is to see $1 trillion in cuts by the end of May. It's certainly ambitious, Danny.
It is ambitious. And look, regardless of what the figure actually ends up being, maybe the more consequential thing is how many people lose their jobs as a factor of this. Bob Elliott from Unlimited did some work basically saying that 800,000 people would likely lose their jobs. And he says that's something that the market is not pricing in right now.
Absolutely. And part of the reason why is maybe because we haven't seen it in the data. We'll get another update next week, but might not exactly see that follow through for the next couple of months or so. But in any case, we'll continue to follow that story and check in on shares of U.S. Steel, because they're up right now after reports that Nippon Steel is weighing as much as $7 billion of investments in the company. Details next. This is Open Interest. All right, welcome back to Open Interest, a check on stocks. We have this cool dashboard behind me. I've never seen it before. The NASDAQ 100 down right now. You can see that the VIX is rising, volatility coming back into this market as stocks fall. And here are the reasons why. You can see that Alphabet, Palantir, Lululemon all dropping to the downside right now. Tesla, which is right behind me, you can see pretty much still building, trying to build on it, those gains that it saw yesterday, up about 0.4%. Not enough to lift this market, rather. Let's take a look at another company that's doing pretty well on this Friday morning, and that is U.S. Steel. Shares rising on reports of a Nippon Steel investment. Nippon Steel is said to be looking into putting as much as $7 billion in to upgrade U.S. Steel. For more, let's bring in Bloomberg's Richard Bork. So it seems like they're still trying, Richard, to get this deal done.
Yes, they are. I mean, we saw earlier this month that the Justice Department announced that they were extending some deadlines for opening arguments and to delay these in order to give them some talks. And, earlier this week, we saw that, I think two important points from this announcement. One, earlier this week, we saw Hyundai announce a $6 billion investment to build a steel mill in Louisiana to support theirs and Kia's auto production. So likely Nippon looks at this as maybe a way to support Japanese auto manufacturer production in the U.S. And two, I think more importantly, this, as far as U.S. Steel is concerned, this kind of indicates that maybe $7 billion is capital that needs to bring their blast furnaces up to snuff. So I think that's an important point here. But more importantly, it sounds like, we've seen the Trump administration cut a lot of deals for investments. There was an article on Bloomberg this morning that, tallying up over $800 billion of investments in the U.S., and this is further proof of that.
Richard, Trump, though, has been very clear in the past that he doesn't think a Japanese steelmaker should be able to acquire U.S. steel. Even with the announcement of more investment or the reporting of that Trump, again, he has said that he would welcome announcements of such nature, to your point. Would he really let this go through? And if not, what other structure could this deal take that placates the Trump administration?
Well, I think first and foremost, Trump is a deal maker. So I think, it's kind of posturing. I think he will be open to a deal that, if it cuts the right way, absent a full investment by Nippon Steel in order to get control and things like that, I can't see Nippon Steel making a $15 billion purchase and agreeing to invest more money without having, full control of the situation. So I think that, their game plan here is to make the next necessary investment and promises to get control of U.S. Steel.
Well, Richard, let's add some context to this conversation. Set the scene when it comes to the overall steel industry. We're all very focused on these two players and this deal, but you've chatted on this show about potential steel tariffs, for example. What does the overall industry look like right now, and how is that filtering through to the actual equities?
Actually, we've seen prices start to come off peaks, and we've seen indications that demand is slowing down. The question is demand actually slowing down because of, consumers pulling back, or is demand slowing down because of uncertainty created by all these tariffs and businesses trying to plan their futures? So it should be interesting in the next few months to see what happens as far as demand pickup. You saw that Cliffs earlier this week announced that they're idling their Dearborn facility, which supplies to automakers. We've seen a big big pullback in auto production. So we'll probably see prices continue to kind of limp down here for a while until the economy and businesses kind of figure out what's happening with all these tariffs and how it's going to affect the businesses long term.
All right, Richard, have a great weekend when you get there. That is Richard Bork talking to us about U.S. steel jumping right now. And I can't say the same for the broader indexes. You can see the S&P 500, those losses deepening, threatening the weekly gain, down about 0.5%. Big tech down a little bit more, 0.6%, and then those small caps that we were talking about can't catch a bid, down about 0.7%. That is your laggard right now. An interesting note coming in just in the past few minutes, this coming from David Lefkowitz of UBS, trimming his S&P 500 target, revising it down to 6,400 for year-end 2025. It had been 6,600, so a re-rating of expectations there. But Danny, I have to say, even 6,400 feels kind of far away right now.
It does feel far away because we've seen estimates much lower than that from other banks downgrading. Torsten Slok has been saying that because of tariffs, you've seen it show up in the soft data of bad consumer confidence, that it will show up in the hard data. But Bank of America, for example, says we trust the hard data right now. There is still a big divide.
Yeah, of course. Now we're all going back and looking at historical relationships between soft and hard and what eventually happens. Again, we will get another check really on the labor market next Friday, just 1 week to go. But before we get there, coming up in our next hour, Lauren Goodwin joins us of New York Life Investments, Flexport CEO Ryan Peterson, a real check on the consumer and, of course, on the shipping industry. All of that and more coming up. This is Open Interest. 30 minutes into the trading day on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Danny Berger. Matt Miller and Shonali Bastick are off today.
And coming up, more cracks in the consumer. A key inflation gauge picks up as spending barely rises. We'll get the final read for March of the University of Michigan consumer sentiment momentarily. Meanwhile, the Swedish investment firm EQT announcing a $23 billion funding raise. We'll talk to the company's president in just a few minutes. And bracing for the tariff wave, we'll talk to Ryan Peterson, the CEO of Flexport. It's one of the largest end-to-end logistics providers, about what he's expecting. But a quick check on these markets right now. We were talking about sort of those losses accelerating. You can see accelerating even further. The S&P 500 down about 0.6%. You can see a bid coming into the bond market with the 10-year yield now off by about 7 basis points. We do have that final read coming through for March for that University of Michigan consumer data. Let's get right to Bloomberg's Michael McKee. What do we see?
We see some bad news. We are even more depressed than we were halfway through the month. The headline number comes in at 57, down from 57.9. Current conditions, 63.8 from 63.5, so that's a little bit better. But expectations sink again, 52.6 from 54.2, and even worse, the Michigan inflation numbers get worse. The one-year inflation forecast is 5% now, up from 4.9% in the preliminary report, and the 5 to 10-year inflation 4.1%, up from 3.9%. So all across the board, this is not good stuff, and it follows a PCE report this morning that wasn't particularly good stuff. So the Fed has something to watch. They're not going to act on it at the moment, but as we get ready for Liberation Day, this is concerning, I think, to the American people.
And we have heard more Fed speakers come out, Mike, and say, we're watching inflation expectations. Susan Collins being the most recent of which, who came out earlier yesterday saying that she is looking at long-term expectations. Is something like this the worst of their fears then?
This is kind of the worst of their fears in the sense that they watch inflation expectations because it tends to drive consumer behavior. You don't want to get into a situation where people are going to their boss and saying, I need a raise because of inflation. That didn't happen in the post-COVID era, but it did happen in the 1970s and 80s. So they keep a very close watch on that. But the part of the issue is that if people are expecting inflation and companies have to raise prices to keep their margins because of tariffs, then they're going to feel more able to do that. And so it just becomes a harder all-round thing.
Yeah, and you can see the S&P 500. It hit session lows in the wake of this data, currently down about 0.6%. Really appreciate the breakdown there from Bloomberg's Michael McKee. And let's keep this conversation going right now, because joining us is Lauren Goodwin of New York Life Investments. She is the economist and chief market strategist over at that shop. Great to see you in person on this Friday.
Oh, thanks for having me.
So we were just talking about when the soft data starts to really show up in the hard data, that deterioration that we're seeing. And certainly there has been some deterioration when you take a look at these University of Michigan numbers.
That's absolutely right. And I think investors should expect to begin to see some weakness in the hard data starting as early as next Friday with the payrolls report, because we're likely to see the impact of government job loss in that report. But even looking forward, it's one of the big mysteries of economic analysis and market analysis that consumer expectations don't always make their way into consumer activity. And one thing I'll point out is, though inflation expectations, we are starting to see that in the mix of how consumers are spending it on goods over services. Just as an example, the overall expectations are still above 50. We're still seeing engagement with the economy, still seeing spending. And so when I take that balance of what it means for the markets, not so bearish, not so bullish, but it's an environment where I think investors should expect pretty modest equity market returns this year. We're looking at something low, mid, single digits, call it 5%.
We are hearing from companies, though. It is more than just some of the headline survey data. Lululemon being the latest of which we heard from Target, Walmart, Delta, Nike, Best Buy, just to name a few. When you look at them, how much do you say corporates are using this as an excuse for maybe their strategies not being right-sized versus this is a problem and the consumer is feeling the pinch?
It's a little bit of both. And one thing I think is so important for investors to consider in the backdrop of company announcements like that is that even if we got perfect clarity on tariffs on Liberation Day, or actually even if tariff news was completely rolled back, there was some disruption where the administration says, you know what, forget it, we're not moving forward with this plan. Many of these realities related to global supply chains, capital-intensive spending around AI, energy, security or independence for companies, these are investments that they have to make. And these are resources that companies, not just companies, but countries as well, are competing over. And so we see some of these elements of supply chain disruption as being relatively durable for the markets, even if we had more clarity on the tariff backdrop.
I do think that's such a good point, because a few months ago, it was, okay, maybe it was the strong dollar that was going to be used as a scapegoat. Now you have a really easy one, and it's pointing to all this tariff uncertainty, because at the end of the day, the only person who really knows is President Donald Trump. But I want to talk about how you position a portfolio around that. We asked that question to Leisha Shallett just about 30 minutes ago. Her answer was more of those domestically focused companies. Maybe you take a look at equal weight indices. What's your answer?
I stand on the side that says these long-term trends that we're seeing develop are happening, and it's probably time for investors to make relatively meaningful portfolio change. And there's two elements of that. One is acknowledging that we're likely to have a volatile year, maybe a couple of years, and positioning equity portfolios in particular for resilience. So we like large caps, in particular dividend payers, to generate some income in the equity portfolio, and we're strongly encouraging investors to close their underweights to international equity. But there's also, I think, a really interesting opportunity for investors to leverage the fact that corporate credit in the U.S. in particular is incredibly healthy. And so we're deploying some equity-like risk in high yield. Yes, we would likely see price volatility and credit spreads widening if there were a downward shift in expectations. But whether companies can cover their debt costs over the next 2 to 3 years is not something that we're concerned about at all in the high quality segment of that asset class. And so if you do expect 5 to 7% on the equity market with a lot of volatility, buy and hold in a high yield portfolio for a couple of years makes a lot of sense.
I want to dig in on high yield, because also going back to that Leisha Shallett conversation, I mean, she mentioned that small caps have become junkier because those high quality, smaller companies are getting the funding that they need in the private markets. But sort of on a similar note, I've heard that maybe the high yield indexes are becoming a little bit more high quality, is because you have all the problem childs going into the private markets. I'm wondering how you square those circles.
A large part of that is true. We have seen the, let's call it, middling quality of the high yield segment move into the private markets in the lower for longer period, because that made sense from a capital stack perspective. And so what you have in high yield is more of a bifurcated asset class. You have the triple C junkier stuff that's still there, and frankly, until recently was outperforming. And then you have a really high quality segment of a high yield portfolio. So that shift into the private markets is certainly happening. But there are a couple of things I think investors can keep in mind. The first is that another major improvement in quality for the high yield asset class was Fed programs during the pandemic, allowed issuers to borrow for incredibly low interest rates and create cash buffers that they're still benefiting from today. The second thing to keep in mind is that what then does that mean for investors that are looking to the private markets to build some diversification? For the average retail investor, most of that exposure is happening in the large and mega space, where products have become available more easily. But we actually really like the lower middle market, the sort of smaller company space, as a way to create more diversification in a portfolio, more sincere diversification, and capture some of those early stages of value creation that are harder to find in the public markets.
That was all very thoughtful and intelligent, but I couldn't stop thinking about how I said children, problem children. God. Dan, help me.
Grammar is meaningless, Katie.
It's Friday.
It's a new era. It's a Friday. We're all ready to go home. Well, this one's for the children then. And just, Lauren, in talking to your clients, you have these recommendations. How willing are they to jump in and buy right now? And I ask because there was this Allianz survey that showed over 50% of their clients expect stocks are headed for a crash. I mean, that is a pretty dour assessment of where they are. Are you getting pushback when you say there are opportunities? It is time to be invested in this market.
Of course we're hearing that. In fact, I would bet there's not a investor or a financial advisor listening to the program who hasn't had their phone ringing off the hook of, like, how do I get out of this market? And that's where I think that the data like we've seen today is a really good example. We are likely to see growth moving lower. I think we are likely to see inflation moving higher. But when we think about sort of the market backdrop, we're still starting from a high base. Stagflation and some of the fears that folks have around the market really falling off a cliff, those are difficult to happen unless you have the stag, unless you have growth move much, much lower than what the average investor is expecting. I also still get a sense of sort of a buy the dip mentality in the market. And so one of the things we're constantly reminding investors is that though there's so much uncertainty, there are clear through lines of these policy changes that we're seeing related to digital and energy infrastructure, frankly related to inflation resilience. And so even if you're not willing to take more risk, you may need to make change in order to build that resilience for a portfolio.
Well, Lauren, that's a good note to leave it on. Always wonderful to see you. That is Lauren Goodwin of New York Life Investments. Now, coming up, EQT raising over $23 billion in its latest infrastructure round. Alex Darden, he is EQT Partners President, joins us next on the company's plan. That's next in our Wall Street Beat. This is Bloomberg.
Time now for Wall Street Beat. Today we are looking at one of the world's largest private capital funds, EQT. The Swedish investment firm raising over $23 billion for its latest infrastructure fund. It's focused on transforming energy and digital systems over the next 2 decades. Pleased to say that Alex Darden, EQT Partners President, joins us now for an exclusive interview. He is also the head of EQT Infrastructure Advisory Team Americas. Alex, thank you so much for joining us this morning.
Thank you for having me.
So a big fundraise also comes off the back of EQT's flagship fund raising a solid amount earlier this year, too. It's been a tough environment for fundraising. So where is that demand coming from?
Yeah, I think, first of all, we're very pleased with the result we achieved with Infrastructure 6. I think it's going to be one of the largest fundraisings over the past 12 months. We increased the size of our fund by about 35% versus the prior vintage. So as you see, and as you say, there's increased demand there. I think we have had very strong support from our client base. About 70% of the commitments came from our existing clients. And they generally increase their commitments by about 20%. But that still left plenty of room for new clients, including some of the private wealth clients that we're developing. And I think, to answer your question directly, it comes from performance, where we've had a very strong track record investing in infrastructure over the past almost 20 years. It comes from the asset class itself, which in this environment, the critical nature of infrastructure, the inflation protection, the cash generation, and the growth at this point is very important. And then lastly, from the business model and the EQT business model being very thematic investors who are looking to drive value creation.
And we do want to quickly mention some breaking news. We've been watching the IPO of Coreweave. We do have some early indications now that Coreweave shares indicated at $50. Remember that the IPO was priced at $40, so a bit of a dislocation there to the upside. Again, Coreweave shares indicated at $50 versus pricing of about $40. We'll keep an eye on that one, Danny.
Yeah, and for what it's worth, this is a data center business, and I'm presuming, Alex, that data centers are going to be part of what's put to work in this fund. Are you concerned at all to see someone like a Coreweave that's had to take a lower IPO, to see Alibaba warning that we're approaching something of a bubble in data centers, and Microsoft also reports that they're starting to pull back on spend?
Yeah, so number one, if you look at the digital generation over the past 5 years, that has grown by almost 4 times. So we're still creating new digital content every year. You look at the move to the cloud, personally, professionally, people are still moving there. The point of that being that there is still exceedingly large demand for digital storage and digital transmission. So we feel very positive about the opportunity set that exists there for data centers. And even if people pull back a little bit, the overall size and scale of what we need to accomplish, not only in the U.S., but also globally, is just massive.
Well, just to dig into that a little bit, I mean, you bring up Joe Tsai, for example, the chairman of Alibaba. Some of the specifics to his warning were that basically you have the build out potentially outstripping initial demand for these AI services. You have Microsoft and its peers spending hundreds of billions of dollars on the build out. So if you game plan for a future where there is overcapacity, how do you mitigate that risk?
So I think there are two things to think about. The first is that the data center itself is not the only piece of infrastructure that has to go in. So I think when we start talking about the supply side, it is going to be much more complicated to execute on that demand than just by saying we're going to build a bunch of data centers. We need power, we need connectivity. There are a lot of pieces that go into it. So that's the first thing. The second thing is, again, there are massive demand drivers here, and they are not slowing down in any way, shape, or form. So even if there is some level of overshoot on what the projected demand is, it is still massive growth. I mean, if you look at 5 years from now, data centers in the U.S. are supposed to be the 10th, 11th largest consumer of electricity on the globe, and that's versus countries. This is massive opportunity that exists within that sector. So even with some downgrade, there's still a lot of demand.
So the hype maybe is warranted, but what about the geographic difference? Because we're at this moment, Katie and I have been talking about this during the show, DOGE cuts, ideas that you won't have as much spending coming out of the U.S. as Europe embarks on a huge change of fiscal spend, specifically in infrastructure. How does that change the geographic opportunity set for you?
I don't think it does. I mean, without sounding too Pollyanna and optimistic here, infrastructure is an asset class that has got huge tailwinds for the next 10, 15 years. I mean, whether you're talking about the electric grid, whether you're talking about new forms of generation, whether or not you're talking about the digital that we've been talking about, logistics and sort of the replumbing of society for the way the world is going to develop from a trade standpoint over the next few years. If you look at the U.S., we've got all of this investment from an industrialization standpoint, from the digital side, from an electric generation and transmission standpoint. If you look at Europe, they've got new demands for energy security, for infrastructure quality to make them more competitive on a global dynamic. And if you look at what the governments are focused on, they're probably thinking a lot about defense spending and increasing their defense spending right now. So for private investors in the infrastructure space, there is a massive opportunity that exists across both geographies.
Well, your fundraise stands out for a couple of reasons. One of them being that we haven't seen a lot of this type of activity. We've been talking about all week, basically, this pullback that we're seeing in deal activity. Talk specifically about your industry and the competitive landscape there. Have you seen activity slow specifically in your slice of the market?
No, and I'll say what I've been saying a little bit differently. If you look at infrastructure over the past 20 years, when it's really been an asset class, a lot of what has driven infrastructure is the fact that it's a critical, essential services to society asset class that's very stable, cash generative, inflation protection. What we have now is demand growth across every single segment of infrastructure. So again, the digital things that you guys have been talking about, but we haven't even talked about connectivity. If you look at the infrastructure bill, it was trying to drive fiber connectivity in the U.S. where we have sort of 50% of society that has access to it, and that's it. If you look at energy, the distribution of the grid, we've historically been centralized generation stations, and that now has to change as we develop a new type of grid. So all of these opportunities are growth within the infrastructure sectors that didn't necessarily exist 10 or 15 years ago.
Alex, has there been, though, any pullback at all? Because we're hearing from industry to industry of so much uncertainty right now, of inability to really commit to CapEx when you don't know what tariffs are going to look like, when you don't know what policy is going to look like. Has that not hit you at all, even on the margins?
I mean, at all may be a strong statement, but I'll give you another good example. One of my favorite things to read is the American Society of Civil Engineers report on U.S. infrastructure quality. Came out recently. We're a C. That's not very good when you're thinking about the fact that infrastructure supports the economic development for the country, its competitiveness on a global basis, and just the general provision of services. I mean, look, everybody sort of forgets about infrastructure and doesn't really think about it until it doesn't work. Think about the supply chain in 21. Think about some of the brownouts that have happened around the country at various times, the curtailment of generation assets because we don't have a transmission grid. So it's there. But we have to, as thematic investors at EQT, what we're focused on is really picking the spots within those core segments that we're focused on. And there, it's been very strong demand drivers and tailwinds on a continual basis that I think will get stronger.
Well, Alex, looking forward to seeing how you put all that money to work. Thank you so much for joining us this morning. Now, still ahead on the show, a Bloomberg scoop. The EU is planning concessions for Trump as the tariff battle rages on. You're watching Open Interest.
All right, welcome back to Open Interest. Let's take a check on these markets right now because losses deepening. We have wiped out that weekly gain on the S&P 500, now down 1.2% at session lows. Even worse, if you take a look at the NASDAQ 100, off by 1.6%. And we were already down on the day, Danny, but it was those University of Michigan final numbers that we got at the top of the 10 a.m. hour that seems to be really spooking traders right now.
Right, inflation expectations rising quite notably in some time. The superlative is in some time that we've had this. It's interesting that bonds are rallying this morning, though. We are trading this as economic weakness, not necessarily one of inflation moving higher and a Fed on pause.
Exactly. The 10-year Treasury yield now down about 8-9 basis points. What's interesting, you can see that it's really the bid coming into the long end, sort of backing up what you're saying, that people are basically buying bonds as a haven bid. Higher inflation, sure, but higher growth or slower growth is certainly scary as well.
Well, the good news is that bonds are working. They're doing their job. They're providing protection. And for that, a lot of investors, I'm sure, are thankful. Okay, coming up, we catch up with Ryan Peterson of Flexport on tariffs.
Well, the shipping industry is in the crosshairs as Trump's tariffs are set to take effect next week. Here now to talk about how he plans to navigate the waves is Ryan Peterson. He's the CEO of Flexport. It's an end-to-end supply chain platform. So, Ryan, we are counting down to Liberation Day. Give us some color on what this would mean for you, for your customers, and basically everyone who has to fill out a customs form.
Well, yeah, thanks for having me on. So right now there's just a huge amount of uncertainty. So on some level, people are looking forward to it, maybe you might say. I don't know, maybe the way you look forward to getting through a hurricane if you're living on the Gulf Coast or something. It's no one really wants this to happen, but what business does need is certainty so you can start to plan. And the role of government, they've got to set up the rules and the systems, and then business people can find a way to make money and make it work. But right now, it's very unclear what the rules will be, so it's hard to make decisions.
Hard to make decisions, hard to know what the outcome will be, Ryan. But given that uncertainty, just as it stands alone, can you categorize just how bad of a supply shock or supply interruption we might see? Are we talking on the level of strikes, of COVID, of something different, of something in between?
Well, we really don't know how bad the tariffs will be. They've already been racking up. So, I mean, you've had tariffs, depending on what your category is, but you've had at least 20% addition to what was already there of 25% if you're importing from China. Then if your product's made of steel or aluminum, it goes a lot higher. And then the Venezuela stuff hasn't hit yet, but China imports oil from Venezuela and therefore should be hit with another 25% on top of that. So you're already, for a lot of categories, you're already close to 100% duty coming out of China. So, we'll see what they add to that on April 2nd. And then maybe there's going to be some non-tariff things. We have this U.S. Trade Representative is talking about imposing big fees on goods or on ships that are made in China, which every fleet in the world, every ocean carrier has ships made in China. So it's just going to keep racking up. And yeah, it's really hard to say. I think it's a little bit more incremental and there's a little bit more time to plan for things, but it's a lot of uncertainty right now. And people feel quite a lot of paralysis about how to set up their supply chain, where to do it, unless you're ready to come back and do manufacturing here in the United States, which for a lot of companies is just the cost prohibitive.
Yeah, and we've heard that across industries from multiple types of CEOs. But take us a little bit further into those conversations that you're having with your clients, with your customers. How are you advising them on how they can insulate themselves from these potential tariffs, if at all?
Yeah, well, there's a lot that you can do. I mean, first of all, your tariff is a duty rate multiplied times the valuation of the goods. And when it was times zero, you didn't really care how the goods were valued, and you didn't go through. There's quite a bit of perfectly legal ways to reduce the valuation of your goods the way that they're declared. And you have to go through the right formal process. But things like if you've done a lot of R&D to develop those products, you can amortize that. CapEx that you've put into your factories, if there's components coming from other countries. So this whole Flexport offers this service called Trade Advisory, where we take people through these lists of different ways to optimize. So things like that. If you import something and later export it, you're owed a refund. Every year, $7 billion goes unclaimed. That number is going to go up with new duties coming in. So there's all sorts of strategies to make things better. You can't solve the problem, but you can certainly mitigate it.
Well, it's not even just cost, Ryan. We're at this moment where waterways themselves are becoming increasingly political. They always were to some degree. But we had C.K. Hutchinson, local media, reporting that they're not going to be signing the deal to sell the Panama ports to a conglomerate because of the pressure from China. What is at stake with these types of waterways, with ownership and ability of ships to go back and forth being used as a political pawn?
Yeah, and we're back to an era really we haven't seen since World War II and before that. The U.S. has kind of guaranteed freedom of navigation, and it's been the foundation of the global order that any ship can go to any port in the world effectively and do business, and everybody can trade with everybody. And in the old days, you used to have cannons on your merchant ships and protect yourself. And so we sort of take that for granted. But now we're entering a new world where the Red Sea, the United States has been unable thus far to put a stop to the terrorist attacks in the Red Sea. All the world's container ships have been diverting and not using the Suez Canal. That's a massive deal. As you mentioned, Panama, this sort of geopolitical game that's being played right now. We'll track that. I mean, it's really early to say. That news just broke this morning, so we'll see if that deal does or does not go through. But yeah, we may be heading into a new world where things that we just took for granted for the last 70 years are now less certain.
Yeah, and maybe we'll get some more clarity when we finally do reach Liberation Day next week. But before we get there, I want to talk a little bit about your business specifically, the business of Flexport. Do you have a timetable for when you might become profitable?
Well, our current plan is by the end of this year, but there's a lot of uncertainty in the mix right now with tariffs, and on some level they're good for us. They create a lot of demand for our tariff advisory trade services that I was mentioning. Really bad for our customers, so you won't sit here hear me celebrate those tariffs, but they do create a lot of demand. They make us more important for our customers, but some of those customers' businesses are at risk, and you may see some of our customers fail. We're working really hard to help them with these things. You may see an overall demand for global logistics services go down. On the flip side, one of the interesting things here is as supply chains move, what you actually end up seeing from a logistics standpoint is that the goods may be shipped twice. So something that a component used to just manufactured finished goods come from China, shipped to the United States. Now what you see often is components from China going to a place like Vietnam, and then from Vietnam on. So you actually do two shipments instead of one. So some of these things, there's a lot of nuance and complexity to it, but it does make forecasting hard. Our goal is to get profitable by the end of this year, and then really bright things for us as we compound and generate high returns on invested capital for many years to come.
I mean, Ryan, that makes complete sense. I mean, you were briefly profitable during COVID, so that tension and the ability to capitalize off of it makes sense. Now, you spoke with the Wall Street Journal yesterday saying that you still aim to take the company public. Ryan, what do you need to see align in order for you to feel comfortable to bring Flexport to the public markets?
Yeah, I mean, Flexport's a platform for global trade. We every time we sign up an American company, we on average will get 18 of their factories to become users. And so you can think of us like a social network for trade. Trade is a lot more important than your friends. So if a social network for your friends is worth $1 trillion, we think Flexport can be an even bigger company than that over time. So we will be a standalone, independent, important company in the world. We want to be highly cash flow positive and have better forecasting abilities. Right now, it's a little tricky to forecast, as I was just mentioning, and there's all kinds of variability. And I think Wall Street wants to have a little bit more certainty about what the future looks like, and you be able to, back up your quarterly projections. Some of our big public comparables don't even provide projections. I think they've been in the business for 50 years or more, so they have a little bit more of a track record to stand behind. It's kind of rare for a new entrant, a new IPO, to say, hey, we're not going to provide guidance. So those are some of the things that we have to wrestle with.
Absolutely. It's a tough market out there. Well, we look forward to keeping in touch, of course, as this trade picture gets even more complicated. That is Ryan Peterson of Flexport. Let's talk about those markets more, because the S&P 500 really extending its losses right now at session lows of down 1.5%. A lot of that pain is coming through in big tech. You take a look at the NASDAQ 100, now down almost 2%. We were looking at a weekly gain at the close yesterday. That has been wiped out and then some. And that's, of course, as we talk about the Coreweave IPO today. It's a difficult day to be going public, Danny.
It's a difficult day if you're already public, let alone trying to become one.
True.
Now, with that, let's look at some of the stocks on the move. Joining us is Bloomberg's Bailey Lipschultz. So, Bailey, I know you've got Coreweave on the mind as they attempt to be one of the companies that will be on the move. What you looking at?
Yeah, well, starting with Coreweave just briefly right now, indications around $45 a share. Did price at 40, but these numbers can fluctuate so quickly. So keeping an eye on where those indications are, but really expecting this to open up in a few hours. But one company that is among the worst performers in the S&P 500 and among larger companies is Lululemon, guys, down 15%. This coming after fourth quarter results were strong, but guidance going forward was far weaker than analysts were expecting. The company talking about potential uncertainty around a U.S. consumer trying to stay up on the trends. I don't know if you guys enjoy going to Lululemon.
Yes, we do.
But they have been expanding into things like golf and kind of trying to get away from just yoga products. And it's working out, but not as quickly as they were hoping.
Well, you're alone in that, Katie. I don't. Everything is size too small. It's like my confidence takes a dive every time I step into Lululemon.
This is a good real world example, you know, and
Correct.
this is how potentially we talk ourselves into a recession or so. But let's keep going on these retailers. You have Lululemon, but you also have Oxford, which is the parent to some of these brands we know and love. Tommy Bahama.
I love Tommy
For
Bahama.
example, Matt Miller pouring one out somewhere. What's going on with Oxford?
Yeah, company under pressure. Right now only down about 4.5%. Was down as much as 15%. Outlook weaker than expected. I don't know if you guys are sensing a trend. We heard from Nike. We've heard from retailers across kind of the spectrum outside of maybe the top 1%, talking down expectations around what the path forward looks like. Obviously, certain companies are going to be hit by tariffs, but the big thing is if consumers, especially in the U.S., if that's where you're selling products, are feeling the pinch and not wanting to spend on more discretionary goods, that's going to hurt your bottom line.
Finally, you're also looking at U.S. Steel. Bailey, this is the deal that will not go away.
I just wanted to end in one way or another. We thought it was done, but now it's back potentially, according to a report, that this deal could be salvaged. Though, again, we do have hurdles, mainly President Donald Trump in the White House. Though we did see the report from Semaphore saying that Nippon Steel now potentially in talks with the White House about doubling their investment in U.S. facilities to $7 billion. That initially was $2.7 billion. Trump had said just a few months ago, or maybe last month, that maybe a strategic investment would be more on the table than an outright takeover. But it does seem like an interesting time for this to play out, again, ahead of Liberation Day, with the geopolitical landscape as it is, and with the threat of a trade war. Are we calling it an active trade war?
I think we're at that point, and at least we have a deal to talk about. Didn't you have a great big take about how all of those hopes and dreams for M&A are going away?
They're going away. Okay, again, first quarter was better than last year, but when we heard from bankers and lawyers right around early November that Trump was going to cut all the red tape and everyone was going to be making deals and going public, as we're seeing with Coreweave and as we've seen with the lack of an M&A boom, those optimistic kind of notes are maybe second half. But again, come second half, maybe it'll be 2026.
Yeah, once we get through this detox period, Bloomberg's Bailey Lipschultz, he'll be covering Coreweave all day, so make sure to keep an eye on his coverage. But coming up on this program, it's larger than the TV, film, and music industries combined. In today's Wall Street Week, we'll take a look inside the video game market and what's driving it. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. The video game market is estimated to be around $200 billion globally and growing. Bloomberg Wall Street Week host David Weston explores the industry and how one game in particular is creating a lot of buzz.
The really big hits of today, the Call of Duties, the Fortnites, the EA Sports Football Clubs, the Grand Theft Autos, like they just keep becoming more and more dominant.
In addition to being an avid gamer himself, Doug Kreutz is the Senior Media, Entertainment, and Gaming Analyst at TD Cowen. He's been following the industry trends for decades and has witnessed one game in particular outshine the rest.
GTA 5 has sold over 200 million units life to date, which is far and away the most that any video game has ever sold. It's not even close. Has probably generated $10 billion in revenue life to date.
Lines are long, but it's pretty worth it.
Rockstar Games, a subsidiary of video game holding company Take-Two Interactive, released Grand Theft Auto 5 back in 2013.
Today, it's still the standard bearer for the industry, even though it was launched so many years ago. And that's kind of astonishing in a business where the technology is continuing to change at a pretty steep rate.
Strauss Zelnick is the chairman and CEO of Take-Two, which is also behind successes like NBA 2K, Borderlands, and Red Dead Redemption. But all eyes are on its next installment of the Grand Theft Auto series, GTA 6, set to be released this fall.
I saw the trailer and it was pretty crazy.
I'm excited. I played 5 a lot growing up.
I would be willing to spend 100. It's just that legendary.
The anticipation for that title may be the greatest anticipation I've ever seen for an entertainment property, and I've been around the block a few times.
It's been 12 years now. Why does it take that long to come up with 6?
We set an intention, actually, to rest our intellectual property. So some of our competitors come to market very regularly, maybe even annually. We think you need to create enormous anticipation on the one hand. On the other hand, it takes a long time to develop these big, robust experiences. Rockstar Games seeks perfection.
Take-Two is a major publisher and developer of AAA titles, a classification used within the industry for high-profile games with high budgets.
Luckily, we have the balance sheet for it. And it's one of the reasons that, standing up a company in a garage today will be awfully difficult. So in a way, the incremental costs have enhanced the barriers to entry to benefit companies like ours. We have team sizes that are as small as 20 people in the mobile space and as large as thousands of people in the console space.
Even after spending all that money and time developing a game, how does a company know if it will be a hit or a miss?
You would look at the sales of the last iteration, or in the case of new intellectual property, you sort of get a sense of what you think that thing looks like and compare it to other similar releases. We have consumers come in and play the games along the way and give us feedback.
That was David Weston on the highly anticipated GTA 6 release this year. You can catch Wall Street Week every Friday at 6 p.m. Eastern. And speaking of games, this is a fun one. Bloomberg.com has a new one for you. It is called Pointed, the news quiz for risk takers. Use strategy to navigate our trivia questions in the week's news and markets, politics, luxury, culture. The more you know, the higher you score. Katie, I've started to play this week's. I've already gotten a question wrong. I think you might be better at this than me. You can also add leverage.
Yeah, it's actually super fun. I encourage everyone to go play it. I started out really risk averse, but by the end, I was wanting to go triple leverage on every single question. It was a little bit addictive.
I feel like you're about to leave us to start a hedge fund after doing this. You're like, I'm all levered up. I'm ready to go.
Well, I didn't tell you my score, which is an important part of that, but that's on Bloomberg.com/pointed. Now, coming up, the ETF world takes a trip to Sin City. We'll discuss the takeaways from the annual Exchange Conference in Las Vegas. This is Bloomberg. Well, earlier this week, key players in the ETF industry gathered in Las Vegas for the Exchange Conference. Bloomberg's Emily Grafeo joins us now. She and I were both there on the ground covering the event, still jet lagged. At least I am. Emily, it was funny. The hot topic of last year's conference, which was in Miami, by the way. This was my first trip to Las Vegas. We were talking about multi-share classes all last year, and then this year, it seems like that was still the hot topic somehow.
So now we have at least 50 issuers filing for multi-share class. I think last year the number was maybe like 6 or 7. So the anticipation is really picking up. But something that happened right before the conference was that acting chair Mark Ueda of the SEC said that he wants the staff to prioritize the application. So I think that kind of set the tone for the conference. Issuers who have these pending applications for the dual share class structure came to the conference feeling pretty optimistic that now the SEC is going to pretty quickly review these applications. One conversation that we had with a number of different players in the market is just how prepared is the infrastructure to actually approve what could be thousands more ETFs coming to market if really 50 issuers suddenly get, ETF share classes tacked on to their mutual funds.
It could be an absolute tidal wave. So to set the scene a little bit, I mean, Vanguard had this patent for multi-share classes where it could issue ETFs basically as a share class of their mutual fund. So a lot of issuers, it feels like, are looking to that as maybe a way to stem the bleeding from their mutual fund arms.
Well, I think the most important question here is why wasn't I invited to what was clearly a fascinating conference, and is Vegas better than Miami for the conference?
I asked issuers this. I don't think we'll be writing a story about this, but I did collect string. Vegas or Miami? And the consensus was Miami.
Yeah.
People preferred that. The time zone difference is a little odd. There were some issuers from the West Coast who were at Exchange. The Capital Group was there, Double Line, but they also come to Miami, so.
Yeah, people know how to get to Miami. That is
they don't know how to get to Vegas.
Miami is a well-worn path. I think that a lot of folks were a little bit grumpy about having to be on the plane for a little bit longer. We actually both gambled, and we came out with net positive gains, so I'll just put that out there.
Congratulations.
Thank you. Yeah, I can buy myself dinner. But Emily, another big topic of conversation was, of course, private credit. Apollo, or rather just State Street was there. Apollo wasn't there, but State Street was there. Anna Paglia, of course. That certainly made a wave, and there were a lot of questions about whether you really need private credit in the ETF wrapper.
I mean, just look at the flows that PRIV has had so far. They're pretty minimal. I did ask a couple analysts, what do you make of the fact that there was what seemed like a lot of anticipation for this product, and we haven't yet seen that kind of play out in the flows? People weren't actually all that surprised. It's not a product, it's not like the spot Bitcoin ETFs where this is an asset class that retail already was, trading in and wanted the ETF vehicle in. So that kind of seemed like an open-ended question of we'll have to continue to watch how many more issuers actually file for what is kind of a more complicated structure, and whether retail actually, wants it in an ETF form.
Yeah, I mean, just judging by the flows into PRIV, it's been live since the end of February. It's only seen 2 days of net inflows, which is pretty amazing. And you haven't seen that pile on, to your point, of other issuers following State Street's lead. Emily Grafeo, great to see you back in New York City. Have a great weekend when you get there. And tune into ETF IQ every Monday at 12 p.m. Eastern. You can also read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETFIQ newsletter. But let's quickly go back to these markets right now. On this Friday, a sell-off is underway. The S&P 500 down about 1.5%. Big tech really bearing the brunt, Danny, of that sell-off. And you can see the NASDAQ 100 currently up by about 1.9%. Not session lows, but pretty darn close.
And you have to imagine a lot of this comes from a really bad University of Michigan final number coming out. Usually the final number doesn't change this much, but this time it did. And I think it's notable. Omar Sharif from Inflation Insight pointing out that the decline was among all demographics, all political affiliation. That means independents, Republicans, and Democrats saw deterioration in their outlook.
Yeah, which is pretty amazing. We've been watching that political divide, and we'll have to see, of course, when that soft data, as we've been talking about, translates into the hard data, maybe at our next NFP report coming up next Friday. But before we get there, coming up Monday on Open Interest, we'll be joined by Raymond James Chief Investment Officer Larry Adam, as well as Katerina Simonardi of Morgan Stanley. Have a great weekend when you get there. This was Bloomberg Open Interest, and this is Bloomberg.